Marc Ostwald, Global Strategist and Chief Economist, ADM Investor Services. Good morning and thank you for joining us.
Good morning.
So Marc, we saw the retail sales month on month unchanged and of course year on year plus 51.2%. What's your comment on the data? And certainly then we're going to take a look, of course, at the inflationary pressures.
Well, I think there was always some risk that we would have some weakness in this number after the inordinate strength that we saw in previous months. So to some extent, there's a mean reversion. The fact that we managed a flat reading on headline is only down to the strength of auto sales. But we're seeing some supply chain disruptions, and clearly what's happening and what had been hoped to happen is that the reopening of the economy would see things like restaurant sales pick up, but clearly that displacement hasn't quite happened for the stay-at-home activities. So it's a bit of a correction. The year-on-year numbers are essentially meaningless because they are basically in comparison with inordinate weakness this time last year.
I just want to move very quickly to the CPI and the PPI, hotter than expected, that's for sure. Actually, way hotter than expected, way hotter than anticipated. What's your comment? Do you think it's a transitory inflation or structural?
We don't know is the first answer. I think the sensible thing for everyone to do at the moment is to ignore the actual year-on-year numbers and work on the 3-month and 6-month annualized numbers. So clearly there's a sharp pickup. 3-month annualized headline 7.2, 3-month annualized core 5%. Some of that will obviously pass because some of it is due to supply chain bottlenecks, reopening pressures, lack of staff, which is happening because we're not reopening everything and therefore some staff aren't available. And so that we are getting these so-called skills shortages, but that will be transitory. And then we've got things, you have the auto prices, but the auto prices tell us two different stories. New auto prices only up 2% year on year. The used auto prices up 21% year on year. Now, the new auto prices tells me that there's not actually a huge amount of inflation out there. The used auto prices tells me that basically stimulus checks have come through. It's given some affordability for those receiving them. And because of the lack of new autos, there is pressure there. But I don't think it's necessarily anything other than transitory. The other indications really at the moment, we need to look at 2 to 3 months trends. And at the moment, it's the whole quarter that we need to have a look at before we really start passing judgment of how much of this is going to be structural and how much of it's going to be transitory. I think the important thing that people need to bear in mind, whether it's CPI, whether it's PPI, is the things which are meant to bear down in inflation at the moment are the things which are in the most scarce supply, i.e. semiconductor chips. If we're going to see a big push back down from technology on inflation, as most people anticipate, then we do need to sort out the supply chain problem in the semiconductor sector. And as many of the big CEOs of the big manufacturers have said, the problem, the worst of the problem probably be over in 6 months, but it'll probably take up to 2 years to get capacity up to the sort of levels that we need. So there is going to be pressure there, and that downward pressure from technology to a certain extent is going to be offset by this shortage.
This week we saw a bunch of macro data, macro indicators that are extremely important specifically for the United States. As we've mentioned just a few seconds ago, retail sales unchanged on a monthly basis, and of course plus 51% when it comes year on year. Then we saw also inflation and jobless claims. By the way, jobless claims continued a several week slide to new pandemic lows in a sign hiring is primed to strengthen as workers return to the labor market. Worker applications for unemployment benefits fell to 473,000, but on the other side, we're noticing a very interesting development in the United States, which is a lot of job openings and a very small demand. How do you explain that? And do you think the Biden administration program with one-off payments has anything to do with that?
To a certain extent, the PUA, Pandemic Unemployment Assistance, and the emergency measures are still discouraging some workers from returning to the labour force. There is an additional factor, because when we talk about restrictions being lifted, it's not everything. So quite a number of workers may be wanting to go back to work, but due to a lack of childcare, or due to nurseries not being open or schools having restricted access, they can't actually return to work. So it's going to be some time before we have everything up and running. So there's a combination here of some disincentives from the payments that are being made, and on the other hand, the fact of the matter is we're not actually reopening these economies evenly. And then thirdly, we've got a further complication, is we're actually seeing quite a lot of movement of people. So some of the jobs are actually in the wrong places because we've seen quite a lot of people moving from state to state as a result of the pandemic. So it's a complex picture.
It is a very complex picture. On the other side, vaccination campaign is going pretty well in the United States, that's for sure. So I was wondering, after all we saw this week in terms of economic calendar and of course macro data, do you think the Fed is going to change anything in 2021 in terms of monetary policy, and do you think it is needed?
Well, I think the Fed is definitely going to be behind the curve. They've said themselves that their policy is going to be reactive. There's no doubt about that. They are going to come at some point under pressure if these 3-month and 6-month annualized rates, particularly of core CPI, remain persistently high. They will, for the time being, say, look, one swallow doesn't make a summer. Just because we've had a big jump, and to a certain extent, if you look at the March versus April labour data, they seem to be justified. But it's really how the whole picture emerges over the second quarter. And then I think they're going to come under some pressure. And there's certainly, I think a lot of people will be looking for them to make sure that they have a very early announcement of when they're going to taper. And it's at that point, when they do start to change the narrative, that they are, in the very first instance, having a discussion about tapering, that markets will see a stern test, simply because there is so much leverage, positioning is so heavily skewed, and as we've seen, whenever we've had little downturns it doesn't really matter what we're talking about, whether it's credit, whether it's equities, commodities, though commodities are a special case, we don't have a lot of underlying depth to the liquidity in terms of, if there is a sell-off, who's actually going to catch the falling knife.
Well, that's pretty interesting. On the other side, how do we have to interpret the market movements in the past 3 days? First of all, of course, after the CPI, we did see a major sell-off. Then yesterday, bouncing back after jobs report or jobless claims. And of course, after PPI inflation. So how do we have to interpret markets?
Well, I think Wednesday's data was a shock. There's no doubt about that. To a certain extent, I think it was a case of bad forecasting. To a certain extent, I think it's an overreaction. It shows that there's a lot of complacency in the market because of the Fed's narrative. The second thing is we didn't have a big reaction, if we look at it, in terms of U.S. Treasury yields. Yes, they went up a bit. But what we're talking about here is a percentage point in price terms of the move in move terms. So it's minimal. If we were suddenly going to hitting 2% in terms of 10-year yields, then we probably have something to talk about. But this is snail's pace stuff, and the market's not going to be unsettled by it. Secondly, one does have to remember, yes, 1.7, 1.8% is a lot better than the 0.9% on 10-year yields that we were seeing last year. But is it something which is attractive to end users and investors? No, it's still financial repression. So the temptation to stick with the buy the dip narrative that a lot of investors have had, perhaps with a little bit more caution, is going to remain there, because we have, unless we can feel that there is a major trend, and this would require Fed endorsement for higher long-term yields. I'm talking about something which is going 2.5%, 3% in terms of 10-year. then the temptation is to look at risk assets on every setback to say, well, there must be something which has fallen quite disproportionately relative to other markets, which is worth picking up and which is perhaps not so overvalued as it was.
So you're not disturbed of the bond market movements. We do see though way higher BTP yields, which is quite interesting. We're going to be there in a very while. First of all, I just wanted to ask you very quickly, of course, what's your take on everything that's going on with commodities? How do we have to interpret this this major surge since the beginning of the year, which is kind of on a pause mode right now? Today?
Yes. I mean, we had a fairly sharp correction in commodities yesterday in quite a lot of cases. A lot of the moves have actually been parabolic. In agriculture, it's a combination of bad weather effects and Chinese demand. In the oil market, we are getting some greater optimism, and the fact is that OPEC or OPEC Plus are not opening the sluice gates of production at the moment, and we are getting these revisions. So, I think commodities basically are doing well, in part because it's a momentum trade. Everything is a momentum trade at the moment. I think that's what people need to remember. There are a lot of people chasing commodities simply because they are going up, not because they have a particular view on inflation, not because they have a particular view on the growth outlook. It is just purely a momentum trade, and a market which is moving, which is precisely what treasuries haven't been doing, and that's where the encouragement has come. If we start to see more significant moves in US Treasury yields, in bond yields, which have moved up somewhat more than US Treasury yields, then there are going to be some problems for the riskier assets, and I think particularly for commodities, it then becomes an interplay between how much, how many of these moves are justifiable. Let's take iron ore just as one example in China. No one expected the price to keep on carrying up because they thought demand was going to drop off because of the restrictions being put in place by the Chinese authorities on steel producers. And what have actually the steel producers been doing? Well, they found a shortage of supply due to supply chain disruptions, and as much as they want to throttle back their production, what they've actually seen is the raw materials, iron ore, going up so sharply that they've had to chase it higher, because there's a difference between having lower levels of output and running the risk of running out of raw materials to make your final materials, and then having to shut down your factory, and reopening it is very costly, and shutting it down is very costly, and you're better off chasing up the raw materials. But at some stage, as the Chinese authorities have already intimated in the last couple of days, they may come down with their heavier hand there. And particularly, I think, with regards to Chinese demand, if we see any sign that there is a bit of ebbing demand from China, then commodities are somewhat more at risk, particularly those ones which are very much dependent on Chinese demand.
Well, that's very interesting because, many people were saying, many economists were saying that actually most likely the Fed and other central banks kind of underestimated this major surge in commodities prices, specifically the crude oil. But I just wanted to have a very quick take before we go into a commercial break. When it comes to the 10-year BDP, I'm talking about a yield. We are at 1.08. Just all of a sudden, we don't have an explanation so far. Do you have one?
I think to a certain extent it's a reflection of the fact that in the first quarter Europe was perceived to be way behind the UK and even further behind the US in terms of having a pickup. If you look at all the incoming data that we've got coming out of pretty much most countries in Europe, and also the pickup in the vaccination rates, that's a very important aspect. You're basically getting a lot of upside surprises, where we're ironically, right now, what we're getting in the US is some downside surprises. So there is a lot of optimism that as these activity restrictions, particularly in May and June, are lifted in Europe, there will be a lot more demand. And with the vaccination rates picking up, And with Mr. Villeroy, I think it was, from the ECB, basically saying once we get to a 70% vaccination rate across the Eurozone, so it will have to be across the whole of the Eurozone, then we need to basically start having a conversation about a taper. And so that naturally does put some upward pressure on all Eurozone yields, but probably above all on the peripheral ones, because those are the ones which have benefited most from the weak economic outlook, relatively speaking, subdued inflation, other than base effects. But if we are to see a pickup, and I think the big test will come with the May and June inflation data to see what impact reopening has on a lot of prices, then we could see some further upward pressure on that.
All right. Thank you very much. Marc Ostwald, Chief Economist and Global Strategist, ADM Investor Services. Have a great weekend.
Okay, take care.